All right, welcome to the Explainer. So, you're a first-time founder, and you're staring down the, well, let's admit it, the sometimes intimidating world of venture capital. You are in exactly the right place. Today, we're going to completely demystify the VC term sheet, giving you the playbook you need to walk into those negotiations with total confidence.
You know, every great company starts with a brilliant idea, but turning that idea into something that actually changes the world, that takes fuel, and that fuel is capital. So let's dive into the high-stakes, but also incredibly high-reward process of fundraising.
You've got to think of fundraising as a game. It really is. It has its own unique language, its own set of rules, and its own strategies. And if you don't know that playbook, you're at a serious disadvantage. Understanding these key terms isn't just helpful, it's absolutely essential to protect your vision, your control, and most importantly, your equity. Let's get into it.
Okay, so first things first. Who's actually on the other side of that table? Where does this money come from? Before we even look at a single document, it's super important to understand the different ways investors pool their money together to invest in a company like yours.
In the early days, you're probably going to hear the word syndicate a lot. So what the heck is that? Well, it's actually pretty simple. You have a lead investor who's kind of like the team captain, and they go out and assemble a whole group of other angel investors. They pool all their money into one entity called a special purpose vehicle, or SPV, and that SPV writes you a single check. For you, the founder, this is a total game changer. It compresses all that time you would have spent chasing dozens of small checks into one clean investment.
So you did it. You found an investor who's interested. That's amazing. But now what? Before you get to what's called a priced round, where you set a firm valuation, you're almost definitely going to see one of two key documents land in your inbox first.
And the most common one these days is, by far, the SAFE. It stands for Simple Agreement for Future Equity. The famous accelerator Y Combinator created it to be a fast, founder-friendly way to get that crucial first money in the door, all without having to get bogged down arguing about what your company is worth just yet. But of course, investors need some protection for taking that early risk on you. That is where the valuation cap comes in. Just think of it like a ceiling. It sets the maximum valuation at which their investment will turn into shares down the road. This is their reward for believing in you early, even if your next funding round is at a way, way higher valuation.
The other key term you'll see is the discount rate. It's pretty much exactly what it sounds like. It gives your early investors the ability to buy shares at a discount, usually something like 20%, compared to the price new investors will pay in the future. Again, it's all about rewarding them for taking that bet on your vision before anyone else would.
So why is everyone using SAFEs instead of the older thing, the convertible note? Well, the key advantage is its simplicity. A SAFE is not a loan, it's not debt. That means it doesn't rack up interest, and, this is a huge one, it has no maturity date. There is no ticking clock forcing you to either repay the money or raise another round by a scary deadline.
Okay, you've taken that safe money, you've built something incredible, and you've got real traction. Now you're ready for your Series A, a priced round. This is where the term sheet comes out, and believe me, the first number everyone's eyes dart to is the valuation.
And we're talking specifically about the pre-money valuation. This is the agreed-upon value of your company the moment before the new investment cash actually hits your bank. And it's one of the most critical numbers in the whole deal because it directly determines the percentage of the company you, the founder, get to keep.
But here's where it gets a little sneaky. VCs will almost always require you to create a stock option pool for future employees. The multi-million-dollar question is, when is that pool created? The answer leads to a really important and often misunderstood part of the negotiation called the option pool shuffle.
This sounds harmless, but it's a common VC tactic that can have a huge impact on your ownership. We're going to walk through how it works, step by step, because understanding this can literally save you millions in equity down the line.
So let's paint a picture. You've agreed to a $10 million pre-money valuation, and you're taking a $5 million investment. Simple math, right? Your company is now worth $15 million post-money. Your original $10 million stake should be 2/3 of that new total, or 66.7%. Seems straightforward.
But then comes the shuffle. The investor asks for a 10% option pool for future hires, and here's the catch. They insist this pool is created from the pre-money valuation, so that 10% pool gets carved directly out of your $10 million stake, effectively dropping your contribution to the deal from $10 million down to $9 million.
And here's the brutal impact of that little move. Your ownership is now calculated based on that $9 million figure. $9 million divided by the $15 million post-money valuation is 60%.
Just like that, you've lost nearly 7% of your company, not to the new investor, but to a future option pool. You're essentially taking the full dilution for future employees before the new money even comes in. This is why that big headline valuation is only half the story. The terms of the deal. That's where the real value is won or lost.
All right, so what does this journey look like over time? Let's zoom out a little and look at the typical life cycle of startup funding.
Each funding round really marks a new stage of maturity for your company. You start at the seed stage, focused on just finding that product-market fit. By the time you get to Series A, investors expect you to have a proven model that's ready to scale, and fast. And you can see that reflected in the valuations, which usually jump pretty significantly between these stages.
And here's a little insider tip. Even the time of year matters. Q4 is historically a mad dash, as VCs rush to allocate their remaining capital before the year ends. Then Q1 tends to be a lot quieter. Now, that might mean less competition for your deal, but it could also just mean slower decision-making from investors. It's something to be aware of.
How you pitch is also changing, big time. A lot of modern investors are former operators. They've built companies themselves. They don't have time for a boring, static slide deck. They want to see your product in action. That's why interactive video demos have become the new standard for showing, not just telling, your story.
As you pitch, you're going to hear about circles. A soft circle is basically just an investor saying, yeah, I'm interested. A hard circle is what you're after. That's a firm commitment. And your whole job is to use every tool you have, a great demo, a clear vision, and a strong grasp of the terms to turn that soft interest into hard, committed capital.
If you take only one thing away from all this, let it be this. The terms of the deal are just as important, if not more important, than the headline valuation. Understanding safes, pre-money versus post-money, and that option pool shuffle, that is your best defense. It allows you to negotiate from a position of strength and truly protect your stake in the amazing company you're building.
Look, this knowledge isn't just academic theory. It's the playbook. It's the foundation for building a massive, successful company. But, and this is the important part, doing it on your terms. Now you know the rules of the game. So the only question left is, how are you going to play?